Now, the Boston Fed president, Eric Rosengren, says he would support tapering asset purchases from next month. He said that the emergency bond buying program is ill-suited for an economy held back by supply constraints. These words come ahead of today's release of minutes from the Federal Reserve's latest meeting and, of course, the Jackson Hole conference next week. Well, Simon French from Panmure Gordon is still with us. Simon, were you a little bit disappointed that we didn't get, much from Jay Powell yesterday, or was he never going to front-run Jackson Hole?
I think you've answered your own question, Francine. I don't think he was going to run Jackson Hole, and I don't think he's actually got the critical mass on the FOMC, despite Rosengren's comments, for a aggressive move at Jackson Hole. I think while the most recent jobs report was encouraging, I think the overall trajectory of the Delta variant in the United States, the overall picture regarding the flexible average inflation target and where expectations are means that I think the FOMC are going to wait until their December meeting. And Jackson Hole, dare I say, it will be framing for the framing. It will set the intellectual backdrop of where they are on the flexible average inflation target, probably offer a few nuggets to the market on how their definition of maximum employment has evolved over the last 12 months. But actually, I don't see the communications fundamentally shifting until December.
I mean, Simon, it's very clear that Minneapolis's Neel Kashkari, is very cautious about the future, and he said again that there will be broader economic implications about the Delta for the U.S. I mean, is that your view as well? How early can we actually seriously think about Fed tapering?
Well, Neel Kashkari is the perma-dove on the FOMC. I don't think his comments should come as any great surprise. That doesn't mean that I don't have quite a lot of sympathy with him. I think he has been proved right during his tenure on the FOMC on a number of occasions, and I think his warning is well made. I think the points that I would make in terms of tapering, it's not clear to me across the whole envelope of asset purchases, the 120 billion, that the ongoing purchases of mortgage-backed securities are justified given where long rates are in the mortgage market. Does the Federal Reserve feel that continuing to add to their stock of purchases is providing accommodative financing conditions to the real estate market that otherwise wouldn't be there? I'm far from convinced that is the case, and therefore there is possibly a halfway house here, which is the mortgage-backed securities element of the 120 billion envelope tapers somewhat earlier than the Treasury's purchases.
Simon, what's your take on the UK inflation reading today?
Yeah, so to be expected that inflation in near term is going to pull back. There's a lot of lumpy data, not just in the UK, but globally in the inflation year-on-year comparisons. July was quite strong in 2020 amidst what was a weak inflationary picture. I think what we'll see is a really strong rebound in UK inflation in the August print in a month's time, because what was known as the Eat Out to Help Out scheme here in the UK, which suppressed the costs of eating out hospitality because of a government subsidy, that's going to come into the August data, meaning we'll go back from about 2% up to near enough 3% and stay high, I think, for a couple of quarters before it starts to come back on a more sustainable basis at the end of Q1 2022.
I mean, will there be limits actually to what, if there are limits to what central banks can do, and there must be, of course, are the markets going to feel it? Are you expecting some kind of catalytic correction?
Well, I think Danny at the top of the hour was talking about the VVIX and investors taking protection into some potential volatility as that communications message that we spoke about, that's not just relevant to the Fed but to all central banks. There's a potential for a policy mistake, perhaps not a material policy mistake, perhaps a communications policy mistake, which is of course part of the toolkit. And I think that is one of the reasons why we've seen volumes in markets across all capital markets reduce down, because it was such a strong H1 that a lot of fund managers, portfolio managers, are actually taking insurance through what are going to be thin volumes for the next few weeks during the summer break, but then also into the fourth quarter, trying to preserve some of those really strong gains. So I think that is both the seasonal effect and also the risk of bungled communications is one of the reasons there's a more cautious standing at the moment.